Hello and good day to all my students. This is the continuation of the previous video lecture titled Investment Appraisal Part 2. So this is our table of content, what we're going to cover for this video lecture. First of all, we're going to talk about adjusting for risks and uncertainty in investment appraisal. Next, we are going to talk about the investment appraisals under capital rationing. So we begin our video lecture by talking about sensitivity analysis. So what is sensitivity analysis? It is a technique that questions how much will the net present value of the project be affected if there are changes in the project's variable in the future. Okay, so if you recall in the previous video lecture on the part 1 of the investment appraisal, we have discussed on how to calculate the net present value by determining the differential cash flows, the terminal cash flows, as well as the initial outlays. Okay, so the relevant cash flow that we use in order to calculate the net present value are based on estimation and forecast, probably based on the past performance or based on our competitors' performance. Okay, because they are simply a forecast, therefore the actual project may differ from our forecast. Therefore, we need to calculate the sensitivity analysis on the project to see how much would net present value be affected if the cash flow that we have forecasted differs from our estimation. So it is a technique that allows us to measure to what extent a relative change in project variable will result in the project's net present value to become zero and therefore no longer feasible to be accepted. Okay, for example, if the sales demand dropped by 20% as compared to what we have forecasted, or if the variable cost increased by 10%, then what will be the impact of this scenario to our original forecasts of the project's net present value? Would the net present value will still be positive? So we want to know the sensitivity of the changes towards our NPV. So these are the 3 steps in calculating the NPV, calculating the sensitivity analysis. So first of all, we need to identify the net present value, which we have already covered in part 1 of the video lecture under investment appraisals. Next, we're going to calculate the present value of each of the project's variables. Okay, and then we calculate the sensitivity margin. So I take an example question from textbook, page 321, Ramrod Berhad. The company is considering a project which requires an initial investment of 100,000. The forecast that says sales for the first 3 years will be 100,000, and we also estimated that the variable cost to be incurred are 50,000 per year for the first 3 years as well. And the company's cost of capital is 12%. So the question asks you to calculate the sensitivity margin of the following project's variables. So we have 3 variables here. One, what will happen if the initial investment change? And the second variable is the sale, meaning that what will happen if sales changes? What will happen to our net profit margin? Sorry, our net present value. And the third variable here is the variable cost. So if variable cost differs or varies from our estimation of 50,000, what will be the impact on our net present value? And lastly is the cost of capital. What happens if our current cost of capital is no longer 12%? What happens if it becomes 14% or 16%? How will it affect our net present value? So in order for us to do this, remember the 3 steps on the previous slide. We need to calculate first the net present value. So these are our cash flows. We have the initial outlay of 100,000, and variable costs which incur every year for the first 3 years, 50,000, and sales which we will earn for the next 3 years, 100,000. Okay, so this is similar to the net present value timeline, which we have covered in part 1 of the video lecture. So this is our cash flows. We have inflow of sales, 100,000, and we also have the outflow of cash flow, which is the variable cost of 50,000. So since we incur this every year for 3 years, then we can calculate the present value of cash inflow, just like we have covered in part 1. Present value 12%, annuity 3 because it is consecutive and even. So we get discounted cash flow to be at 240,180 for cash inflow, and our cash outflow will be the 120,090 ringgit. Therefore, our present value of cash inflow will be at 120,090 ringgit minus the initial outlay, so that we can get our NPV to be at 20,090 ringgit. So we have calculated our NPV. Okay, since the question also asks for the sensitivity margin for the cost of the capital, we need to calculate first the internal rate of return so that we can compare and see the sensitivity margin for the cost of capital. Okay, so previously we have calculated the NPV at 12%, so we need to find another rate that will give us a negative NPV. So we go higher, and I found out at 24%, the NPV is already negative at 935 ringgit. So we do an interpolation as we have already discussed in the previous video lecture, and we get our internal rate of return to be at 23.47%. Alright, the next part of the next step, first we do calculate the net present value. Therefore, the second step here is to compute the present value of each of the variable. So here we have 3 variables that we can see, which are the sales variables, cost, and also the initial investment. Since initial investment is already at year 0, so we don't need to calculate the present value for that initial investment. We only need to calculate the initial the present value for the sales. It incurs in year 1, year 2, and year 3, as well as the variable cost. So we already calculated this when we calculate the net present value previously, if you still remember it. So we have found that present value of the project variable sales is 240,000. Present value of project variable cost is 120,090 ringgit. So this is the formula to calculate the sensitivity of the project variable. NPV divided by the project variable that you want to find. So if I want to find the sensitivity margin for the initial investment, therefore NPV divided by initial investment. If I want to find the sensitivity margin for the sales, so NPV divided by the present value of sales variable. If I want to find the sensitivity margin for the variable cost, therefore net profit margin divided by the present value of the variable cost. So I've calculated for you, and I found out that the sensitivity margin for initial investment is 20%, sale is 8%, variable cost is 17%, and cost of capital is slightly different because they don't use the net present value. Instead, what we do is we find the RRR minus with the cost of capital that we have previously forecasted, divided by the cost of capital, and we get the sensitivity margin for the cost of capital. The commentary or the interpretation for the 20% sensitivity margin for the initial investment is, if initial investment increased by 20%, then the NPV would be 0. Okay, so we must make sure that our initial investment do not exceed the 20% threshold in order for the project to still be feasible to be accepted. And for sale is that we must make sure that our forecasted sale do not decrease by more than 8%, otherwise the NPV will be 0. And for the variable cost, we must make sure that the variable cost must never exceed the increment by of 16.72%, otherwise the NPV will be 0. And for the cost of capital, we must make sure that the cost of capital do not increase by 95.58%, meaning that if it's more than 23%, then the NPV would be 0. Okay, these are the advantages and disadvantages of sensitivity analysis. So let's discuss this for a bit. What are the advantages of sensitivity analysis? First of all, it identifies which variable that is very sensitive to the changes, and therefore those variables should be given priority and close monitoring. So the lower the sensitivity rate margin, the more sensitive the project variable is. So for example, in the previous calculation, we found out the lowest sensitivity margin is the variable cost, which is at 8%. Which is the sales variable, which is at 8%. So we must carefully monitor the sales so that it would not deviate so much from our forecast figure, in order to make sure that the NPV would still remain feasible. The second advantage is that it is a simple technique to apply. The third advantage is it reinforces the importance of proper forecasting. So that because if we do not forecast our relevant cash flow properly, the sensitivity margin will become very sensitive, and therefore any changes, any big changes or small changes on our forecast will have an impact on the viability of the project. The disadvantages of sensitivity analysis is that first, it did not take into account the interactive impacts of all variables critical for the project. It assumed that variable cost doesn't have anything to do with the sales, or maybe fixed cost doesn't have anything to do with sales, which is not entirely true, because we know the more cost we incur, the higher would be the sale. And therefore, this underlying assumption that changes variable can be made independently is not very realistic. The analysis does not incorporate probabilities or event happening, and therefore it doesn't incorporate risks. So this is the problem of sensitivity analysis. So we do not incorporate risks that may happen in the future. And lastly, the analysis does not offer a clear decision rule that there is management judgment is still required. So what if the sensitivity margin is 8%, 20%, or 70%? Because we do not have the clear-cut criterion rule. For example, like NPV is positive, we accept, or PI is more than 1, we accept. But for sensitivity analysis, we do not have the clear-cut criterion rule whether the certain figure we calculated is good or bad. So it still requires a management judgment. Next, we talk about the probability analysis. So this is similar to the one that we have covered in risk and return topic, where when we calculate the expected return. So probability analysis focuses on the maximum value that a particular project can generate under different future outlooks and outcomes. This approach may use a forecast or a situation or event where several possible outcomes are measured, which is called as expected value. It is computed by multiplying each possible outcomes for its probability of occurrences and then summing up the results. Project that gives the highest expected value should be selected. So I take this for example. This example from textbook, page 325, Zoom Berhad. Zoom Berhad is considering to invest in either of these two projects, Project BEE or Project CEE. The following forecasts are available for the company to formulate a decision. So these are the forecasts that the experts have already found out for you, this is similar to the expected return under the risk and return topic. So it shouldn't be a problem for you. Okay, so it's a required compute the expected value for each project and determine which project should be chosen. So I calculate for the expected value for project B. by multiplying the probability with the expected with the return, and then I sum it up to get at 300,000. For project CEE, I get 325,000. So here we can see project CEE has higher value of 335,000. Therefore, project CEE should be chosen. However, it should be noted that project is also risky because it had a wider range of potential outcomes compared to project BEE. Here, you can see here the difference between the return when we get the recession, if the economy went into recession compared to if the economy went into boom. We have a deviation of around like 250,000. Sorry, a deviation around 150,000. Whereas for BEE, the deviation is only around 100,000. So of course, EE has higher risk and therefore higher return. Alright, so these are the advantages and disadvantages of probability analysis. So the advantages are, first of all, the computation are simple and straightforward. So there's no problem in calculating the expected value. The measure take into account that several scenarios of outcome are possible and therefore is superior to the simple forecast. Unlike sensitive margin, where we do not take into account the possible outcomes or the risks attached to the project, probability analysis take into account the risks attached to the project. And thirdly, able to quantify the probability of different outcomes. And then the disadvantages of this analysis is that it is a simple weighted average of probability of outcome, indicating only the average payoff of the outcome. It also ignores the investor's attitude towards risk, because some investors are willing to take higher risk as compared to others. And the forecasting of possible outcome may be inaccurate and complex. So how do you determine like 20% the recession becoming boom, or 10% the economy is becoming recession? So those kind of forecasting may consist some inaccuracy, and that because it is a complex situation. The next one is capital budgeting under capital rationing. So what is capital rationing? So in the previous example that we have done, we always assume that the size of capital budget depends on the availability of acceptable investment project. Meaning that if I have 3 projects to choose from, 2 of them are positive, then my decision criteria is choose the 2 projects that gives positive net present value. Okay. When I make that decision, I do not take into account that perhaps there is a budget constraint that limit us from taking both of the project, even though both of the project gives us positive NPV. Okay. In practice, a company may impose a limit on the amount of capital budget for a given period. Perhaps both of the project that give positive NPV, the total capital initial investment required is 100,000. However, for this current period, I only have 80,000 for capital budgeting. So this is what we call as capital rationing. How do we choose between those 2 projects? So what are the causes for capital rationing? It can be due to 2 reasons, which are the hard capital rationing and soft capital rationing. Okay, hard capital rationing refers to the inability of the company to source or to raise the required fund from external sources, such as banks, creditors, shareholders, equity, or debt market. So why does a company have this kind of problem? First of all, the company may have poor management of financial track record. Maybe they have too high leverage, or too low liquidity, or bad records or profit that cause the business to be too risky to be given a capital required. The second reason is too many restrictions or debt covenant placed by the lender. So debt covenant are the terms and conditions placed by the banks or the lender of the money, which may restrict several of your activities, business activities. in order for you to get that money. So because of this debt covenant, you may not be able to take all of the projects available. The third reason is economic downturn, of course. The fourth reason is if it's a new business, meaning that business that is freshly starting up and having difficulties in accessing and raising funds from the capital market. For soft capital rationing, this is referring to the internal financial policy of the business. The business may impose certain self-restriction to limit the amount available for the project. Why? First of all, maybe because the firm does not want to raise additional capital, as it may lead to outsider gaining more control of the business. Therefore, if the company issue more ordinary shares in order to raise capital, they will have perhaps an outsider can get control of the business via the owning the shares capital. The second reason, the additional share that issued may also lead to the dilution of the earnings per share and therefore affect the ability to obtain more fund in the future. The third reason is firm do not want to raise additional debt capital as to not incur large future interest obligation that will impact profitability of the firm. It perhaps because they find out that their current time interest earned is already too high for them, and therefore they do not want to raise additional debt capital, which may lead to the capital rationing. Firm may also wish to follow the policy of steady growth. For example, they may prefer slower growth and more stable organic growth compared to that of the merger and acquisition in order to remain control of the growth process. Okay, so how can we overcome this kind of hard capital and soft capital rationing? So for the hard capital rationing, we can overcome by entering into a joint venture with another company or entering into strategic partnership that interested in the same project. Or the company can also arrange a contract out parts of a project, meaning that not all of the initial outlay you need to bear on your own. Perhaps some of the initial outlay you can source out to another party to reduce the cost. Find new sources of capital, which includes research. Include search for subsidies or grant from the government or venture capital, or use asset as a collateral to obtain loan, or enter into sales and leaseback agreement. Yeah, these are all the options that you can have in order to raise more fund. For soft capital rationing, you need to have a better management of working capital, assets, and then asset and cost to realize higher productivity and saving. And then we can also slowly increase our retained earning in order to build up a sizable financial slack. And then lastly, enter into lease agreement to preserve cash. So if the company is facing capital rationing, how do we choose which projects to be chosen? Okay, so we cover it under the single period capital rationing. So this refers to the situation where the firm suffers a shortage of fund which is limited normally to one period only, meaning that maybe the limitation is only for this year, but for the coming year sufficient fund will be available. So projects under consideration are categorized into two types, which are divisible projects and indivisible projects. So divisible project is a project where a whole project or any part of the project may be undertaken. Meaning that we don't need to take the whole project, we can only take a part of the project to accommodate with our limited budget. Whereas indivisible project is where a project must be undertaken in its entirety, or otherwise the project must be rejected. Okay, so again, I take an example from textbook, page 339, Platinum Company. So Platinum Company is considering to invest in the following 4 projects, biru, merah, kuning, and hijau. So we have calculated the NPV for each of the project, as well as the profitability index for each of the project. And these are the initial outlay required for us to invest in this project. So the requirements here says determine which project should be selected if the capital budget is only 120,000 and the projects are divisible. Okay, divisible. So this is our capital rationing. This is the maximum amount of project that we can undertake, and we need to find a combination of project that will give us the highest NPV. So I can either use the net present value as my basis of choosing, or I can use the profitability index as my basis of choosing. So here I show you what happens if I use the NPV as my basis of choosing, and what happens if I use profitability index as my basis of choosing. Alright, so if I want to use NPV as my decision criteria, I would choose the one with the highest NPV first, followed by the second highest. So here, the highest NPV is hijau of 7,000, and the initial outlay required is 80,000. Available is 120,000, so after we have taken out the 80,000, the available is only 40,000. So the next project I choose must be the second highest NPV, and it would be kuning. It would be kuning. Kuning is NPV is 3,000 with the initial outlay of 60,000, which means we have insufficient fund. However, the project is divisible, meaning that I can take only a portion of the project and leave the rest out, just according to how much I can afford. So here I only take 40,000 of the 60,000 of the project to use up all of my available capital budget. Therefore, my total NPV here is 7,000 plus the kuning. We do not get the whole 3,000 since we only take the 40,000. Therefore, we only get the 2/3 of the project NPV, which is only 2,000 here, and therefore my total NPV for this choice is 9,000 ringgit. Okay, however, if I choose project biru, now if I use PI as my basis of choosing, I choose project biru first because it gives me the highest highest PI, profitability index. So I take biru first with the initial outlay of 20,000. Therefore, my available capital after I've taken the biru project is 100,000. So then I go to the next highest project that will give me PI, the next highest PI of the project, which is hijau. So 1.09. So I take hijau, NPV of 7,000. Needed initial outlay is 80,000. So available here after taking up hijau and biru is only 20,000. The next one, the next highest PI would be kuning. Kuning 1.05. So 3,000, initial outlay of 20,000, and then we finish off. So my NPV here is 2,000 from biru, 7,000 from hijau, and only 1/3 from kuning, since I only take 20,000 out of the project. And therefore my NPV here is 10,000. So if I use NPV as my basis of choosing, I would choose only a project that will give me a combination of only 9,000. However, if I use profitability index as my basis of choosing, I will choose a combination of project that will give me a total of 10,000 NPV, which is much higher than if I use NPV. Therefore, if the project is divisible, please use profitability index as it will give you the highest NPV available. Alright, so using the same question, the only thing that I change here is that assume the projects are indivisible. Okay, now the projects are indivisible, meaning that I cannot take a portion of it. I either have to take the entirety of the project or I reject the whole project. Alright, so under this, you cannot use PI. We must use NPV as our basis of choosing because this is indivisible project. I mean, I cannot take a portion of it. I must take the whole of it. So please use NPV as our basis of choosing. So you need to take into account all possible combination, and then can you make a conclusion. So for my first possible combination is hijau and merah, and the total cost of the project is 120,000. and the total NPV is 8,000. The second possible combination is kuning, merah, biru, which means I have used up the whole 120,000 here, which will give me a total NPV of 6,000. Or I can also take hijau, okay, and I have available of 4,000, right? 40,000, right? So available 40,000, I can either take merah or I can take biru. So merah here and biru is here. But if I take biru, I have underused my capital budget by 20,000. But it's okay because you can see my total NPV is 9,000, which is much higher than merah, than the first combination. Therefore, choose for the hijau and biru because of the highest total NPV. So you need to find out every possible combination that you can get within the capital budget and then choose the one with the highest NPV. So this is the end of chapter 11, Investment Appraisal Part 2. So please do the rest of the past year question and please check your answer with the suggested solution that I've uploaded in the Google Classroom. Thank you for your time and your patience and for your attention. I'll see you next time. Thank you, class.